All right, let's do topic 9. So, topic 9 might not be on the exam, I haven't decided, but it's an important topic in finance, so we'll talk about this briefly and quickly. Okay, it deals with efficient markets. Okay, so I talked about this briefly in the previous videos, but market efficiency refers to the degree to which prices reflect all of available information. Um, yeah. So what it means is, uh, let's say we have stock. So this is a y-axis. We have price. Time is on the x-axis. Okay. For any stock or an index, you know how the stock price fluctuates, right? And maybe it goes like that. Okay. And let's say right now we are here. This is time 0, and this is in the past. Okay. So what it means is, whatever this price may be, let's say it's $100. This value, this price represents the uh, best uh, best. I'll just call it true or best or fair value based on all information, based on available information. That is, let's say we're trying to price what should we do? Price the stock of Tesla. Okay, so available information means, how is the future of electric vehicles? Will there be a lot of demand? And that will be firm specific information. We talked about it in the topic 8, future of electric vehicles. How is Tesla managing the company? Are they efficient? Now, how is their product compared to other competitors? These would be firm specific information. And then there are macroeconomic factors, the systematic components, market risk, right? We talked about that too. Things like, how is the inflation looking, interest rates, maybe government regulations. So if there's a trend toward moving away from these gasoline vehicles, then it's good for Tesla, right? So these things are more like market related risk. Maybe this would be somewhat firm specific, but you get the point. These are information that determine the price of this specific firm. And what market efficiency is saying is that based on all available information, this seems like a pretty decent price. Okay. So the efficient market hypothesis says that markets reflect all available information. Okay. That is, the current price reflects the true value of the stock based on all these information. Okay. So basically, the current price reflects the true value. Again, true value based on information. Okay, so that's what market efficiency or efficient market hypothesis predicts. And as we talked about at the beginning of the course, some anomalies exist. Okay, for example, we're not going to look at it again, but if you look up the stock price movements of GameStop, AMC, and a bunch of other companies, maybe I think Bed Bath and Beyond went bankrupt, and I think it's trading again. But these stocks at the beginning of 2021, I believe, you'll see the anomalies. Okay, that is, the prices moved mechanically based on a short squeeze, and it dropped immediately. So at this point, the price doesn't really reflect the true value. It's just a broken market at this time. That's why the prices came crashing down and so on. Okay? And the implication on investors would be, yeah, what market efficiency suggests basically, let's say this is time 0 again. Since the current price reflects all information about the firm, basically what it says is you cannot predict the future price. So whether this will go up or sideways or down actually depends on the information that will come in to the market in the future. For example, as I'm recording this right now, you'll probably watch this later, but the US started bombing Iran again. I think, I don't know the whole situation, but the Iranian, or what are they? Not ISIS. Islamic Revolutionary Guard or something, right? IRGC, okay? They attack ships, commercial ships, going through the Strait of Hormuz again, and the U.S. started bombing Iran, and they're fighting again. Okay, so the markets are sort of fluctuating. So at this point, that's new information that came in the market, and obviously the markets react negatively. That's another risk, right? But by the time you watch this video, maybe things will escalate even more, which will drive down the prices even more, or maybe it'll be resolved. Okay, it'll probably lead to a increase in prices in general. Okay, so future price depends on new information that'll come in the future. So unless you know what's going to happen in the future, and it's just not one factor, right? Just war is just one of them. There could be firm specific news. You know, if we're talking about Tesla, Elon Musk might die. You know, I hope he doesn't. But you know, these are all events that no one can predict. Okay, so basically, you cannot predict the future price. Okay? If you knew the future price, you'd be incredibly rich. Okay, so don't listen to people, and there are a lot of YouTubers saying the price will be this and that, whatever. You know, they don't know. Okay, if they knew, they wouldn't share the information with you. Okay. Okay, so in finance and asset pricing, or asset pricing, maybe we'll just say in finance, people try to analyze the stock price or security prices mainly two different ways, okay? Or they combine the two. I think a combination makes more sense. One is called technical analysis. Okay, so you might be familiar, but basically day traders, chart readers, they look at how prices moved in the past to predict future prices. So using past prices and returns or patterns to predict future prices. Okay, from a market efficiency point of view, this is pretty useless, I would say. Not completely useless, but again, at this point, it doesn't matter how the price became this price, whether it moved like this or this. It doesn't matter, because this point represents the true value based on all updated information. Okay, it doesn't matter whether US attacked Iran here or here. You know, maybe we lived in a different world, it moved like this. Doesn't matter. Okay, true value based on current information is what market efficiency suggests. Okay, but technical analysis tries to use the past patterns, how the prices moved, and the important levels to predict the future price. Okay, my personal opinion is that technical analysis is actually useful very short term. Okay, that is in the absence of information. So if you're talking in like within a day or minutes or hours, when no significant news comes into the market, the price that the market is trying to find the right price, then the pattern is actually useful. Again, this is personal opinion, but in the long run, ultimately information drives the price, so you cannot really rely on historical patterns. Okay, but yeah, so you don't need to know these candles, but again, this chapter might not be on the exam, but it's interesting. Okay, the second way that investors use to analyze security prices is by doing fundamental analysis. Okay, so this is more, I would say, more mainstream traditional finance. Okay, so basically they're using economic and financial factors like we did to identify under or overvalued securities. So these would be things like, we talked about the dividend discount model, right? So based on how much dividends they're expected to pay, and based on economic data such as the risk-free rate, we try to come up with the fair price of a security. Okay, let's say you did your dividend discount model, discounted free cash flow model analysis, and found that the price of a certain stock should be around $30 to $32. You can't pinpoint a number, so you come up with the range. You think this should be the right price. Okay, but in the market, let's say the price right now is $25. Then you would say, oh, this price is an undervalued security, therefore it's a good opportunity to buy this stock. Hopefully the market will realize that it's an undervalued stock later on, which will drive the prices up to whatever point it is, and you'll make a profit. Okay, same thing with overvalued securities. Okay, so these are used by mutual funds, investment firms, but I think these days all investment firms combine the fundamental analysis with some degree of technical analysis. Okay, yeah. These forms of market efficiency you can ignore. There's a weak form, semi-strong form, and strong form. You can read about it. It just deals with what kind of information is supposedly priced in to these prices. Okay, so this would be, I would say, this is makes most sense. All public information is priced in. Yeah. And this shows the market efficiency. Just a couple examples. This was a couple years back. Nike had an earnings call, and if I remember correctly, at this point, I'm just trying to show you how quickly the market prices adjust based on information, based on newly updated information. Okay, so as we talked about in the earnings call example, in exam 1, during an earnings call, this private information is made public to investors. So if you think about it, if you think about the logistics, before the earnings call, company has to prepare all the reports, right? So insiders know at this time, during this time period, insiders know what the number is going to be before it's released to the public. But the market price doesn't move that much until the information actually becomes public, which are this point and this point. Okay, so at this point, financial statements were released. So the numbers were good. That's why the prices went up all the way up here. So we can see that it's probably over 5% increase, okay, during this short period of time. But then earnings call began at some point right here, and then the guidance numbers were released. So future outlook was actually worse than expected. Okay, so on paper, the previous quarter's numbers were good. That's why the investors, there was more demand for the stock, drove the prices up, but the guidance was bad. That's why at this level, it started to drop, and it dropped by like more than $10 would be negative 10%, right? And the price is stabilized right here, okay? So the prices are constantly being adjusted based on newly updated information, and this is one of the examples, okay? Clear things up. Yeah. This too was an example of, I would say, a semi-strong form market efficiency that prices reflect all public information. Okay, so if the prices reflected private and public information, the markets wouldn't react this way because private information should have drove the prices down right here earlier on, maybe a couple days before. Okay. Here too, as soon as the market learned that Spirit Airlines is filing for bankruptcy or considering, I don't know what happened now, I think they actually went bankrupt, okay? But the share price dropped quite a bit, right? So as expected. Yeah, I guess a month later, moving towards bankruptcy filing, obviously bad news. And we'll skip this slide and skip this slide, okay? So there's a field in finance, behavioral finance. It's interesting, how people are irrational. There are these characteristics of investors that are irrational, and we are all subject to these irrational behaviors. Me too, okay? And this just shows you don't need to know this, returns versus portfolio turnover. Meaning, this is the S&P 500 annual return. It's like, I don't know when the sample period was. It's a little bit high, but 18% return. And the researchers basically divided the sample up into people who just buy and hold, and here, people who buy, sell very often. Okay, basically trying to time the market. Okay, so it just shows that frequent selling and buying usually doesn't work out well. Okay, it's really hard to time the market. So when you're investing, you should just do a buy and hold strategy. Keep putting money into the stock market, so you diversify away the timing risk too, and just focus on your actual work. Okay, that would be a good advice. Okay, let's move on. So that's that. We'll do topic 10. Where's topic 10? Okay. So this topic is on the exam, but we're gonna skip a lot of the stuff that's here, and the main reason is because in the past at this school, a lot of people didn't do well up to exam 2. Okay, I hope that's different this time, but I don't know. Okay, so yeah, I'll send out an announcement, but the final exam consists of about half from exam 2 and exam 1, but mostly from exam 2, and then half on the new material, topics 8, maybe 9 and 10. Okay, we had a lot of stuff in topic 8, right? Yeah, so I don't want to cover too much to overwhelm you guys. So if you didn't do well in the past, make sure you review the material from exam 2. So I don't want to throw a lot of new material at you at this point in the course. Okay, so we'll talk about capital structure, and I'll show you what to study. Okay, So this slide you saw in exam 1. Okay, it was topic 1, maybe part 2 of the video, but you want to review that video for the exam. There are 2 problems just based on the what I called the corporate finance overview. So again, I'll send out an announcement, but it was topic 1, I believe. Part 2 was the video where I talked about the who shareholders are, board members, the ultimate goal of a corporation, which is to maximize shareholder wealth. And there I talked about how the CEOs are appointed by the board, and his or her job is to maximize shareholder wealth. And how do they do that? There are 3 things, 3 areas of corporate financial management, and it was these 3. There were these 3 areas. Okay, so make sure you watch that video. So the 3 areas were first, capital budgeting. Okay, so if you look at the video, we talked about how, I forget which example, capital budgeting just deals with finding the right projects, finding good projects. So this is related to the investment decision rules topic that we talked about in topic 7. So we project future cash flows. Okay, so we usually project free cash flows, and then we use the R of WACC to discount the cash flows and get the present value. And the present value of free cash flows, if you recall, gives you the enterprise value, right? So maybe it was an ice cream business or a furniture store or a Domino's branch, whatever. Okay, so capital budgeting is this, and if the NPV is greater than 0, you accept the project. Okay? That was the investment decision rule, right? This whole process is called capital budgeting. Okay, and then in this topic, topic 10, we're going to talk about the capital structure decision. Okay, so now that the project, a good project, is identified right here, now it's your job to figure out, let's say usually we find the enterprise value, but there's usually an investment that's required at time 0, right? So it's your job to figure out how you're going to finance this investment. Let's say it required $1 million up front. Are you going to use $500,000 in debt and $500,000 in equity, or are you going to use $800,000 in equity or $200,000 in debt? Okay, so as you saw before, and as we're going to talk about, the ratio of debt and equity determines the WACC, right? Because the cost of debt and cost of equity, they're different, right? We've already established that the return on equity, or the cost of equity, is greater than the cost of debt. So this mix changes your cost of capital, weighted average cost of capital, which in turn affects the value of the project too. Okay, so it's a little complicated, but these are all important decisions, is what I'm trying to say. So capital structure decision, again, is determining how you're going to finance the company's operations. What mix of debt and equity are you going to use? This much equity or this much equity? Okay. And lastly, we have the working capital management decision that we didn't really talk about in this course. I teach this course in the fall, actually, 4250. Okay, so where we talk about, now the project is identified, we've decided on the capital structure, now the operation is on the way. Okay, now your job is to make sure that you're able to meet the interest payments, these short-term financial obligations. financial obligations. Okay, so you want to meet the interest payments, so you want to hold enough cash in the firm so you can make those interest payments. But you don't want to hold on to too much cash that you forgo these other profitable investment opportunities. Okay, so it's finding the balance between holding enough cash to make sure you don't go bankrupt, but making sure you're still investing to increase the shareholder value. Okay, so these are the three areas of financial management. Okay, and we talked about this previously too, how in the cycle of money, the firm could issue debt. Okay, so these creditors will be bondholders. Bondholders. So bondholders provide money to the firm, okay? And firms are borrowing money, right? The basics. So the rate at which this exchange takes place is RD, but depending on who's looking at this, depending on which perspective we take, we call it different things, right? The firm considers this their cost of debt financing, cost of debt. From the bondholder's perspective who made this investment, it's their return on debt, okay? Rate of return on debt investment, okay? Same thing here. The firm could raise capital using equity, by issuing stocks. So shareholders who purchase these stocks are providing money to the firm, right? And from the firm's perspective, they're raising capital by giving up partial ownership, right? So the rate at which this exchange takes place, we said this is RE, but from the shareholder's perspective, the investor's perspective, this is their rate of return on stock investment, return on equity, okay? Return on equity is what we called it usually. But from the firm's perspective, it's their cost of financing with equity, right? We called it cost of equity, okay? So again, we're talking about these same things, but taking a different perspective, okay? Okay, so again, capital structure. It's an important decision of the firm. That's why there's a separate chapter on this. And the ultimate objective is still to maximize firm value. This is the ultimate goal of corporate financial management, right? To give you a separate example, just for fun, since this is our last lecture, let's say, I don't know. Yeah, let's say, I don't know. Forget the example. Okay. Yeah. Actually, I was gonna give an example. Let's say you're someone who's trying to get, like, I don't know, really fit or build muscle. Okay. Not how you spell muscle. Couple different factors, right? You have to eat enough protein, I think. You need to work out, and you also need to rest, right? So these would be analogous to the corporate financial management, where the ultimate goal is to maximize value, okay? We talked about capital budgeting, capital structure decision, and working capital management. So this is just one component, and the ultimate goal is still to fulfill this goal, right? So I don't know if this is a good example, but yeah. Anyway, the objective is to maximize firm value, okay? And as we mentioned before in the previous slide, the enterprise value, EV0, is the NPV of future free cash flows. Okay, we had it back here somewhere. Yeah, something like here. Okay, free cash flows. So yeah, one thing you should know is that the capital structure doesn't affect the future cash flows or free cash flows, but just affects the WACC. Okay, so let's do the ice cream store example. Let's say you're trying to open an ice cream store after graduation. $2,000 required to open the store. In the first period, you expect to make 500. Let's say just 500 forever. Okay. Okay. So this, we'll call this free cash flows. This is how much money, how much cash will be generated from the ice cream store. Okay. But think about the capital structure. Let's say you have two choices. Using 100% equity, let's say you borrow money from your parents so you don't have to pay debt, or you could raise 50% in debt and 50% in equity. Okay, so these things will change your WACC, right? But how you finance the project doesn't affect how much free cash flows generated from the ice cream store. Okay? Let's say you open an ice cream store, no one cares, or the customers, they don't care about how the project is financed. It doesn't really change the profitability of the business, right? So the free cash flows are not affected, but the capital structure affects the WACC, and therefore it changes the enterprise value of the firm. Okay, it's interesting. So as you know, WACC is the discount rate used to discount the free cash flows, so used to compute the NPV. And if you think about the math, the format is usually cash flow over R, right? R is on the bottom, so the firm value is maximized when the WACC is minimized. As the R goes down, the value of the whole fraction goes up, increasing the enterprise value. Okay? And the optimal capital structure is one that maximizes the firm value. Okay? Okay, so these couple slides we're gonna skip. Okay? So, one second. So it shows you how leverage, increasing debt, makes the firm more risky. Okay, so we have a case 1, case 2, case 3. As you can see, the asset value does not change. We're only varying the capital structure, mix of debt and equity. You can look at the slides, but basically you'll see that financial leverage makes a firm more risky. The EPS varies a lot in the high levered case, right? Yeah, but you'll see if you're interested. Okay, for the exam you don't need to know. And example 1 you don't need to know. We're not doing the break-even EBIT, so no need to know. Cost of debt, you don't need to know. Okay, so I just want to show you that in this course I'm giving you the RD usually, but usually firms don't rely on a single source of debt, right? They want to diversify that risk too. So firm raises capital from multiple lenders usually, and RD is the weighted average cost of each debt. Okay. And we'll talk about this after tax cost of debt too. Okay. And cost of equity, again, you don't need to know, but RE can be estimated from, for example, the dividend discount model or from the CAPM. Okay, so these are different ways to estimate the firm's cost of equity. Okay, so no one's in the real world, they don't give you this number, right? Okay, this slide you have to know. So, we're talking about debt financing, the pros and cons. Okay, the first advantage of financing your company with debt, again, for example, let's say $10,000 is required. You can choose to use $5,000 in debt and $5,000 in equity, or you can do like $2,000, $8,000, or you can do everything in equity. Okay, it's your choice or the firm's choice, right? So what mix do firms use and why? So one advantage is something you already know. We've already established in the I think topic 6 lecture that RD is less than RE because shareholders face more risk, right? They face more uncertainty, they're the residual claimants, and debt is relatively safer, so this deals with the risk premium, right? So the cost of equity is greater than cost of debt. So meaning, if the firm chooses this, they get to lower the WACC more than this version and this version. Okay, so if you think about the math, increasing reliance on equity increases their cost of financing the firm. Okay, so cheaper is the key. Okay, and another reason why debt is better is because of this thing called interest tax shield. Let me quickly explain what that is. We're doing interest tax shield. So if you think about the corporation's income statement, we start with revenue and then we deduct operating expenses. Then we have operating income, or I'll just call it earnings before interest and tax. And then we deduct interest expense. Okay? So, yeah. And then we have taxable income. And then there's tax expense. And then we have net income. Right? So, if you look at this component right here, interest expense, it only exists if the firm has debt, right? So with a lot of debt, let's say EBIT is fixed. So just like I mentioned before, how you finance the company doesn't really affect the operating profitability of the firm, right? So let's just say the firm will generate $10,000 no matter what, but if the firm takes on a lot of debt, then there will be a lot of interest expense, let's say $1,000, okay, compared to a case where the firm doesn't have any debt. Okay, so in the all equity scenario, taxable income will be $10,000, whereas if the firm has debt, taxable income will be $9,000. So let's say the tax rate is 10%, then all equity firm must pay $1,000 in tax, whereas this levered firm, the firm that uses debt, has to pay only $900 in tax expense. So having debt, having interest payment lowers the taxable income and lowers the tax expense. Okay, so that's what we call interest tax shield. So again, having debt will increase the interest expense, which will decrease the taxable income. And if there's less taxable income, you can pay less tax. Lower tax is good, right? So that's one good thing about having debt. Okay, that's called the interest tax shield. Okay. But, there are disadvantages too. If it only had advantages, you would all, or firms will all use 100% debt. Okay, but that's not the case. Disadvantage is the biggest one: higher leverage leads to greater bankruptcy risk. Okay, this is the biggest thing, right? So as I showed you before, higher leverage means more debt. More debt means higher interest payments. So if the firm has a lot of interest payments, then when things are bad and they cannot make this interest payment, the firm will go bankrupt. So creditors will be like, you promised to pay me this much, but you have failed to do so. So you have to sell the corporation's assets, sell the truck, sell the factory to pay us back. Okay, that's going bankrupt. Okay, and bankruptcy is no good for shareholders. Again, because shareholders bear the residual risk. They're last in line to get paid. Okay, this was in topic 6, right? Residual risk. They're residual claimants. So when the firm goes bankrupt, shareholders are last in line to get paid. So, they won't get paid anything if the firm goes bankrupt, most likely. Okay, so they don't like this. That will be the direct cost of bankruptcy. And indirect financial distress costs will be things like when the firm goes bankrupt, they have to hire lawyers, and it's just a lot of problem, right? Yeah, so we'll just say, we'll leave it there. Okay? Costly, okay? Bankruptcy risk. Okay. So let's do the WACC calculation. Okay. So the weighted average cost of capital, so far, I just gave you the WACC number, right? Here in this topic, we're gonna start calculating the WACC, and as you'll see, the formula is really easy, and this problem, everyone should get it right. So it represents the overall cost of equity and debt. As the name suggests, we're taking the weighted average cost of capital. That is, cost of debt and cost of equity. We're just taking the weighted average of these two things, RD and RE. Okay. Yeah. So in reality, for projects with different risk, WACC needs to be adjusted. But for the purposes of this course, we'll just use a single WACC to evaluate all the projects. Okay. And this is the formula. Real easy, right? Weighted average cost of capital is the value of equity divided by the total value of the firm. That basically how much of the firm is financed using equity. Okay, so if the total value is $10,000 and the firm uses $5,000 in equity and $5,000 in debt, it's simple, right? Half is using equity and half is using debt. Okay, usually I'll give you the RE and the RD, cost of equity and cost of debt, and then I'll give you a tax rate. Okay, this is maybe like 20%. I think after Trump took office, there was a tax act of 2021, maybe, I'm not sure. Okay, where all corporations pay a flat tax of 20%, but for this course, I'll just give you the tax rate. Okay, so this part captures the interest tax shield component that we talked about. Okay, so we're not gonna just use the RD, because with RD there comes an additional benefit. It lowers the cost of capital by this much, right? Interest tax shield. Okay, so that's the formula. Okay, it's real easy. Okay. Okay, and the solution to example 3 is already posted. You should take a look. And that's it. So hurdle rate slide you can skip. And example 4 you can skip. This slide is important. I don't know if it'll be on the exam, but since we're wrapping up the course, you might as well listen. So it's called the static theory of capital structure, or the trade-off theory. So it just shows you, you want to pay attention to this line right here, okay? This curve right here. So this shows you the value of the firm considering the bankruptcy probability, okay? So what we have on the y-axis is the value of the firm, okay? So the higher, the better. On the x-axis, we have the debt to equity ratio. So at the origin is where the firm is 100% equity financed, basically no debt. No debt. As we go to the right, we're increasing debt. Okay, so that's the basic setting. So again, debt to equity ratio on the x-axis, we're increasing debt as we go from left to right. Okay, so as you see, this is basically, will be done in like 2 minutes. So this is, I hope you watch this. So basically a capital budgeting setting of the entire firm, and we're saying the free cash flows are $100, and we require maybe $1,000 up front, okay? And we're trying to come up with the capital structure. We're trying to change the capital structure to see how the enterprise value changes. So this red line right here will be the enterprise value that changes based on the capital structure, okay? So we're changing the R here, okay? So as you can see, at the beginning, right here, it's upward sloping, right? Because if you add debt, you're adding RD, which is lower than RE, okay? So the WACC decreases. That's why the value of the firm increases, right? Because R is on the bottom, right? So the important part here is up to a little bit of debt, the bankruptcy probability is minimal. That's why it just increases the enterprise value, minimal. But what the graph is showing is after a certain point, the bankruptcy probability starts outweighing the benefits of greater EV, benefits of lower WACC, I'm sorry. So after this point, we're saying, this is getting messy, the increased probability of bankruptcy now outweighs the reduction in WACC. Okay, so overall impact is the firm value starts decreasing at a certain point, and this is the optimal capital structure. Okay, so I hope you got that. Okay, again, to sum it up, at the beginning, just a little bit of debt doesn't really increase the probability of bankruptcies too much, so you just get the benefits from lower WACC. But after a certain point, the bankruptcy probability becomes too large, so the reduction in WACC is no longer that meaningful. This risk becomes greater. Okay, so there's an optimal point. That's it. I hope you learned something. Good luck on the final. Okay.